So let me begin with our webinar. And again, it's just aptly and straightforwardly titled webinar on dividend stocks. No? Okay, so I'm glad to hear that most of you already have a basic working knowledge of how the stock market works, and that in fact a good number of you are already investing in stocks. So picking out dividend stocks is simply one way to choose what stocks might work for you. And again, from the top, this type, it's a particular strategy that I think balances a lot of what's attractive with the stock market, and it balances out with the risks that you might be facing when investing your hard-earned money in the stock market. So what it is, when I say investing in dividend stocks, it's simply a stock picking strategy. So there are many ways to pick stocks. I mean, how many stocks are listed on the stock exchange? There are over 250 stocks listed, 268 to be exact. So how do you choose which one works for you? Again, you could go to any financial advisor and let them help you pick out stocks. You could ask your broker about their favorite picks. You could in fact use fund managers such as UITFs or asset managers so that they can help make decisions for you. But if you'd want to try to do it on your own, picking out dividend stocks is a particularly popular and very easy way actually to start identifying companies that could work for you. Now, before I begin specifically on dividend stocks, I want to introduce everyone to some basic ways to pick out stocks out in the stock universe. And this, by the way, works for the Philippine Stock Exchange or any other stock exchange, Hong Kong, Singapore, Japan, the US. Basically, this is a very popular way to pick stocks. So, what are the different ways to pick stocks? Number one is through fundamentals, which is actually my favorite way of picking stocks. When you say you invest a stock based on its fundamentals, you're basically saying that you're investing or you're buying a stock based on its business, based on what it is as a company, based on its performance. So you are literally buying a share of stock, part ownership in a company, and you buy it with the view that you are now partly an owner of this company. So what are the things you want if you are to be an owner of a company? Those criteria that you want in a successful business, these are the same criteria when you say you're picking out a stock based on its fundamentals. Number two, another way to choose stocks is what we call through technicals or charting. Again, another popular way of choosing stocks. Personally, I'm not as familiar with this type, but it's very popular among some people. What it is you don't even look at the type of business behind the stock. You don't even look at its performance, but rather the main focus is its price movement. So what you do is you look at a graph or a chart of the stock's particular price movement. You try to identify what we call patterns. Patterns there where if a stock has moved a certain way, whether it's gone up or gone down recently, you try to predict where it's going to go next. That's what you call technicals or charting. The third is indexing. Indexing is simply following a pre-selected list of stocks that is put into an index. So in the Philippines, the most popular index would be the Philippine Stock Exchange Index or the PSEI. And in fact, the PSE comes out with some subsector indices as well, such as the real estate sector, the consumer sector. So what these indices do is they track a particular country. So there's a Philippine index or a particular industry or a particular sector, let's say like the real estate index or the banking index within the Philippine Stock Exchange. So it gives you a quick snapshot of how the overall industry in that country is performing from a stock market point of view. So you could simply follow that. For example, if you're bullish or if you're very positive on the prospects, let's say, of airlines in a certain company, you could just pick out an index that's following that particular industry. Take a look at the composition of that index or the members that make up that index. Take a look at their weighting and just follow it. Okay. And in fact, many funds, many asset managers, many investment houses have funds that are simply index following funds. The next way to actually buy stocks is to do market timing, and a topic for another day. But I will tell you, this is the one I would particularly recommend not to follow. Anyone who tries to time the market actually it's more of a roll of the dice. That's my opinion. That's my view on it. It's very hard to time the market. Why? Especially if you're a retail investor, because you're up against the professional traders, the retailers who do this, and not only them, you're up against as of now artificial intelligence, computers, and robots who would pick out the tiniest inefficiencies, the tiniest arbitrage opportunities in stock markets in order to do this. So I would definitely not recommend doing this if this is your first time. But I'm just putting it here as for educational purposes to let you know that there is this particular strategy to picking out stocks. And finally, there are equity screens. Equity screens is a strategy where you identify a certain characteristic of a stock that you like. For example, you only want to invest in stocks who has a large market capitalization, meaning when a stock is a large market has a large market capitalization, that usually means it has a large number of shareholders. It means there are institutions buying into this stock. It usually means it's being covered by analysts. So that's one particular criteria you might want. You might want to look for stocks that meet a certain price earnings criteria. You might want to pick out a stock that meets certain dividend criteria, a particular sector, particular geography. So these are equity screens. Okay, so dividends, actually picking out dividend stock is a type of equity screen. No? So I'll get into the heart of it now. Why would I say that, especially for those with a basic understanding, why would I say that buying dividend stock is a great entry point? In fact, it's a great strategy overall. Number one, I like companies that pay out dividends. And by the way, when I say dividends at this point, I mean cash dividends. Okay, I like companies that pay out dividends. I really like them a lot. I think that they a lot of good. There are a lot of good things about a company that has to happen before they're in a position to pay out cash dividends. So number one, you pay out cash dividends. A company that pays out cash dividends sends the right signals to the market. The right signals for me. I'm looking, because it's a publicly listed company, right? You want to communicate to the investing community, to the investing public, why you are a good firm for them to invest in. And what's the first signal that a company sends to the investing public if they pay out dividends? What they're basically saying is, number one, we have a stable profit margin and stable business model. It's not all businesses are cyclical, but at least for them, they're not as risky as other businesses out there. They're saying that on a year-to-year basis, you can expect and you can rely. There's a certain predictability to their business model and to their profit margins, so that they're able to give out cash dividends at this point, because they won't need to hold that cash, let's say, and hold that cash in their balance sheet, because next year they might face declining sales. They might not have enough money to pay their employees or their suppliers. No, they know they have a good business model working. They know that year on year it's going to produce for them. So that's a great signal to this investing public. Number two, it signifies the right attitude to shareholders. It signifies that they recognize their responsibility and accountability to shareholders. Because at the end of the day, what do you get as a business owner? What you want are returns, di ba? Now, one of the ways usually that people invest in the stock market, they think, oh, how do I make money on the stock market? Well, I sell it in the future if the stock goes up. That's definitely a viable strategy. But if you're looking to buy a stock and you're thinking, I want to be a part owner of this business, you're really looking for a return on your investment. Warren Buffett had a great quote about owning stocks. Someone once asked him, what is your ideal time horizon to holding a stock? His answer was forever. He doesn't buy a stock because he wants to flip it or sell it when it goes up or bounces up the next day and it goes up, let's say by 10%, then he sells it. No, he buys a stock because he likes the business. In fact, follow-up question was, what happens if you buy a stock and it goes down by 5% the next day? You know what he said? He said, I'm happy because I'm going to buy more. What that means is that he has already made a decision that it's a great business to buy into. And it going down 5% the next day only means he can buy more of the stock at a cheaper price. So that's the type of business model, that's the type of business that we're looking at. Second thing about a company that pays out cash dividends, it imposes a natural discipline on capital allocation. Now, I'm not, I suppose I shouldn't use Tagalog here, right? Just English. Okay, I'll use English here the whole time. What do I mean by discipline on capital allocation? When a company makes money and it generates cash, there are many competing competing uses of that cash. You could buy a new buy some new capital assets. Let's say you open up new offices, you open up into new markets, you invest in new products, you buy a new building, you buy new equipment. Uh, think about business. You may want to expand your business. Another way is to another way is to invest in R&D. All well and good, but one use of cash is actually, why don't you return it to your shareholders, right? So what we're saying here is that if a company generates a certain amount of cash, they have to think twice. They have to think very, very carefully if where they deploy their cash is a better use of the cash than just returning it to shareholders. Because if the company has made money already, you as the shareholder, you have a right to that money. But the managers of that company will then make a decision. Is it better that I return the profits back to my shareholders? Or if I have a new project lined up, you better be able to justify it to your shareholders. You could tell them in your board meet or in your shareholders meeting, we made this much profit this year and we're reinvesting that profit into this new project because we feel that this particular project or this particular capital expansion will give you a better ROI than anything else out there in the market. If they're so confident that they can outperform that, then by all means, use the cash for that type of capital allocation. But what we're saying is that if you establish cash dividends, the standard to reinvest that cash into projects is very high. So you better be very sure that that money that the company I own earned is better be put to a better use than what I can use it for. Number three, why do I like cash dividends? Cash dividends are great because you know you can only pay out dividends from retained earnings. Retained earnings come from net income. Those with an accounting background know this. You cannot pay out dividends without retained earnings. And retained earnings come from net income, right? But not all net income are created equal. What do I mean by that? I mean that some net income is not on a cash accrual basis. You know this when you buy a car or you buy a house, right? The sale has been made, income has been recognized, but it hasn't been fully paid for. So why would I say that cash dividends is a great signal? It is because there are some companies, there's some, and it's been established, who engage in very aggressive accounting practices where, for the sake of declaring growing net income, they tend to recognize their income in advance before they even receive the cash. But many things can happen in between closing a sale and actually receiving the cash. Someone could back out, there could be a warranty, there could be a rebate, there could be a refund. So, and more criminally, or the more nefarious or the more dishonest side of the spectrum, I was just talking about business scenarios, but on the more dishonest spectrum, it could be related party transactions, window dressing, all types of accounting malfeasance, as we call it, that could be behind that. So I'm not saying that companies who don't convert their net income into cash quickly always engage in it. I'm saying that there's always that possibility. In fact, that's what brought Enron down and some of the other accounting scandals. That was the root of it. Okay. Next, why do I like dividend stocks? Reason number 4. It's usually a stable business model with a high confidence in their projections. What do I mean by this? I talked about a stable business model, about how they're confident that the business they generate this year, they can replicate it next year. That's because if you start paying out a dividend, investors will expect a yearly dividend. It's in fact more damaging to a company to pay out a dividend in 1 year and then not pay out a dividend the next year, because it only shows that your business is so volatile, your business is so risky that you cannot sustain your performance on a year-to-year basis. So you start thinking about what businesses are stable. What businesses can we not live without? You start thinking about consumer goods. You start thinking about utilities. Everyone uses electricity. Everyone uses water. So these are the business that unless some, of course, barring some tail events or some black swans, as we call it. These are businesses that will continue to make money based on their business model. I'm looking for a business with a moat. Now, this is a term that financial analysts use. It means, a moat refers to, it comes from what it literally means, that strip of water that defends a castle or, defends a piece of land from invaders, right? So a moat means if it's a business that's not easily replicable. It's not that business model is not easily breached. So what could be a type of moat? Number one is brand recognition. It's very hard to sell soft drinks right now, or if you were to start your own soft drink company, because Coke is so dominant, Pepsi is so dominant, right? How hard do you think will it be for you to breach that moat and to have a brand name equal to that? It's really difficult. Geographical mastery. You can think about certain companies who have mastered certain geographies. They've cornered the market for that product in that geography. They have the proper logistics network. They have the proper network to deliver those goods or services in that particular geography, or some other enduring competitive advantage, such as infrastructure development. So, for example, a telco company, very relevant, especially and very germane because of the third telco bid. But not any Tom, Dick, and Harry has the money to come up with telecommunications towers and the capital expenditures needed. Same is true with power generation. You know, one power plant could cost easily upwards of 50 billion pesos, or let's say an airline company. So these are the companies that have natural moats. Next reason why I like dividend stocks, they have increased visibility to asset managers, institutions like SSS. Big fund managers, they usually look for stocks that pay out dividends because that's in their mandate. They have a certain amount of money that they're managing, and it is in their mandate. They are legally bound to only pick stocks that pay out dividends. So I like it that the big boys are also looking at the same stocks that I'm looking at. So these are the reasons why I like dividend stocks. Now, there's the last point I put here is what impact then does it have on your portfolio? One thing to keep in mind, dividend stocks occupy a middle ground between fixed income and growth equities. Now, just to elaborate on that a little bit, what I mean by that is, don't expect that these dividend stocks will double your money in the next year or so. That's not the way they work. That's not their business model, right? You're looking for safe, stable stocks with a little growth component thrown into there, but don't expect outperformance, like, again, doubling your money in the next year or so. But also they're more conservative and the business model is more risk averse. So you also wouldn't expect your money to be wiped out. So it's a more conservative stock play. So that's sorry. So that's why that's sort of the investment space of this asset, what it occupies. Now, it's not fixed income, because in fixed income such as bonds, right? You invest in a certain bond, you give out, let's say, a certain face value principal, let's say 1 million pesos. Then it's called fixed income because you expect a certain fixed return on a quarterly or semi-annually basis, and then at the end of that bond, what we call the maturity of the bond, you get paid back your principal. No more and no less. Of course, assuming there's no bankruptcy or event of default. For stocks or dividend stocks in particular, you get that flavor of an income, of a regular income in the form of dividends, but there is really no maturity. So there is an underlying stock play there that could possibly go up or go down. But again, as with the nature of dividend stock, shouldn't be as volatile as a normal equity play, so to speak. So you might be asking now, what about stock dividends? Because I just talked extensively about cash dividends. No? Now, because a company can indeed pay out stock dividends, and it works out by basically what it does, it increases the number of stock that you own. With respect to all the reasons that I enumerated above of why I like companies that pay out cash dividends, stock dividends are, let me put it this way, stock dividends are okay, but they're not as good as cash dividends, because again, cash is a literal transfer of value already. So the company made a profit. Here you go. Here's cash. Right. So it goes straight in your bank account. You can withdraw that, and that's money in the bank for you. Stock dividends. I mean, they pay a stock dividends. You could always have the option to sell those extra stock that you receive, but then again, it's not as strong, for example, as a reason for the imposition of cash discipline, as I just mentioned above. The advantage of a dividend, however, and it is something to consider, is that it's usually issued at a discount, meaning that if a company were to issue stock dividends, they usually issue stock dividends at a discount to their current price. So For example, if a stock is trading at 10 pesos, they'll say, for by stock dividends, I'll pay you this much dividends, okay, in stock, but the stock will be worth 8 pesos, for example. So they give a little bit of upside to their existing investors. So it's good for accumulating. If ever you wanted to accumulate and own more of a certain business, stock dividends is a great way to do it. It also has a tax advantage in that cash dividends are taxed or levied a withholding tax for individual shareholders. Meaning, if the stock is in your own individual name, there's an automatic withholding tax of 10%, I believe, of your cash dividend. Whereas a stock dividend is not subject to that type of tax. So risks and watchouts of investing in cash dividend, because I want you guys to be well educated and to be very cognizant of the risks and the downsides of possibly buying stock dividends. Number one, I mentioned this, I alluded to this earlier. There is limited upside. Don't expect a quick buck here. Don't expect that this is the type of stock where you speculate, where you buy a stock, then you wait for it to jump 10, 20% in the next few days. In fact, usually that type of stock is what you call speculative investing. There's some sort of news that you're waiting for. You think that this company will be awarded the third telco franchise. You think this company will be bought out by another company. So you make what you call a speculation. You're willing to say, oh, sige, you're willing to gamble and say, all right, I'll take a bet. I think this company is about to be acquired by another company for whatever reason. Then you see if that bet pays off. It could pay off. It could give you 10, 20, or even double your money over in a very short period of time. That's not the play for dividend stocks. Expect a steady growth. Expect them to pay you out cash anywhere between 2 to 5%, for example. That's a reasonable range to expect in the Philippine stock market. And wait for it to return value to you over a longer period of time. Another risk and watch out for dividend stocks. You more likely than not will be investing in a maturing business. When we say maturing business, because when a company decides to return cash to its investors, I mentioned this earlier, one of the things a company foregoes is that they're saying that we don't want to invest in new capital expansion, in new fixed, in new capital assets. We don't think that we should pour so much money into new business ventures or new growth opportunities. We'd rather return the cash to you. It signals that the business has reached some sort of plateau and that the business is close to maturing. I'll give you a very famous example. A company that I admire greatly and I've been following for over 10 years now, Apple. Even before they went out, even before they came out with the very first iPhone over 10 years ago, I've been monitoring this stuff. And they never paid out dividends for the first 20 years, I think, of their existence. Microsoft is another dominant company, also never paid out dividends for the first, I think, 20, 25 years of their existence as a publicly traded stock. Because they always used their profit and reinvested it into their own company, either expanding their product line, again, R&D, new locations, new marketing. And the investors were fine with that because it was a growth stock. It was a company that had many more horizons, many more markets to expand to. But once a company reaches certain maturity, it reaches a certain phase where growth may not be as easily attainable as before, then the case becomes stronger and stronger that it's much better to return cash to shareholders. So it may be a business lacking in growth opportunities, but again, that may or may not be a good thing for investors because it also means that there's less risk involved. Number three, I would suggest that don't just look at dividends, but if you have the time, do your research. Avoid dividend window dressers. These are the worst. What do they do? These are the companies that actually don't make as much money. They in fact borrow money from banks in order just to keep up appearances or just to pay out dividends. These are the dangerous types of companies because it signifies that these are companies who are not able to actually generate cash on their own. So just be a bit careful about window dressing. Look at their net income. Look at their cash conversion. Do they have a lot of receivables and inventory on their balance sheet? And does it coincide or does it make sense that they have that much receivables in their inventory? To those with a little bit more financial analytical background, we call this the cash conversion cycle. So if a company is able to convert
these receivables in inventory into cash at a reasonable rate, then that's a good business. But if it's slowing down, if a company is unable to collect, if a company is unable to sell their inventory at a rate that is market, for example, that is market standard, then I'd watch out for dividend window dressers. To those of you who are living abroad, you might be familiar with options, call and put options. Just to let you, I won't go. This is another topic altogether, so I won't get into too much detail. But just know that buying or selling options, or what we call writing option contracts, in for a certain stock, dividends heavily affect the price of those options. Finally, there's tax considerations. One advice I could give is that if it's worth your trouble, do set up a holding company with the SEC to help and use that company to buy and own your stocks, because automatically all the dividends that go into that company who own the stock uh, receives 100% of the dividend. Okay, but if you own a stock and you get a cash dividend and you own it as an individual, there is an automatic 10% withholding tax. So instead of getting the whole dividend, you're already withheld. It's 10%, right? 10% cash. So there's just that tax watch out to consider. So final topic, my final topic for this particular session. You might be asking now, okay, great, Grant, you've given this presentation, we're excited. So you're probably asking now, so what are your picks? All right. So if you've waited and you've put up with my voice this long, I'll try to reward you with my own dividend stock picks. Okay. So I put up my own dividend screen. I did this as early as yesterday. So I screened for companies or stocks that has a good dividend yield, meaning you compute their latest dividend by their latest stock price. I'm looking for companies who have shown me a consistent multi-year cash dividend payout. I'm looking for companies with stable earnings, not companies who are profitable one year and then in the red next year. And usually I would try to look for companies in my preferred sectors, which I'll get into a bit later. So before I do give you the names of all these stock picks that I have, also would just disclaimers. Okay, these are of course my personal picks, and again, for just so that all of you know, conflicts of interest. I do own some of these stocks, not all, but I do own some of them. So take it with a grain of salt. Take it for what it's worth. So I'll get right into it. Okay. And finally, of course, the disclaimer is please remember that a stock market, the prices are dynamic. They move every day. It may or may not be right for you. Please, if there's one thing that you take away from this particular webinar, it always pays to do your own research, because even if you get a stock call right or wrong, right, it you'll always win by educating yourself about investing in the stock market and knowing about the business. So do your own research, seek out advice. So for what it's worth, I'll give you my own stock picks in terms of dividend plays. First sector, I like real estate plays. Particularly, I like landlords. When I say I like landlords, I like companies that actually lease out spaces, because they are the quintessential recurring income model, right? They're the stable profit. If someone rents space from you, if you own an office property, if you own a residential property for rent, right? That gives you a stable cash flow. That gives you a stable business model by which to expect returns. So who are my favorite real estate plays? Ayala Land, obviously. If you go to their malls, you're contributing to their business. Vista Land is another name to look out for. Of course, part of their big business would be real estate development. They're turning over Camellia Homes, Brittany. Those are the brands that you might be familiar with. Mega World, a big player in the office and rental space. So very stable, very strong recurring income business. And a new growth stock, maybe take a look at them, Cebu Land Masters. They operate mostly in the Vismin region, but up and coming, great performance so far. They only went public very recently, a name I'm keeping my eye out on. Second sector, you'll also want to look at consumer staples. The Philippines is notoriously a very consumer-driven economy. So we are known to that the consumer sector is one of the primary drivers for our stock market in our economy. So the biggest players here are Universal Robina, RFM, and of course the San Miguel FB. In fact they just did a follow-on offering earlier this week. right? So San Miguel FB, they own the most iconic Philippine brands, the San Miguel Pale Pilsen, San Mig Light, Pure Foods, that all belongs to them. And then I'd also look at utilities. Again, I mentioned earlier, everyone uses electricity, everyone uses water, and everyone has a cell phone. So Meralco, Manila Water, and Globe are names to consider when you're looking at a stable business model in terms of companies that have historically paid a certain amount of dividends and with certain good growth rate. Okay, so with that, I'll wrap up my presentation and thank you all for listening.